The Intelligent Investor is one of the most influential investing books ever written. First published in 1949, it explains a philosophy of value investing, a strategy focused on buying stocks for less than their true worth and holding them patiently. The book's central idea is that successful investing is not about predicting the market or having extremely high intelligence. It is about discipline, emotional control, and following sound principles over long periods of time. Legendary investor Warren Buffett, who studied under Graham, has famously called it the best book on investing ever written. The book begins by defining what investing truly means. Graham distinguishes between investing and speculation. An investment operation, according to Graham, is one that, upon thorough analysis, promises safety of principal and an adequate return. Operations that do not meet these requirements are speculative. Many people in the stock market believe they are investing, when in reality, they are speculating. They buy stocks because prices are rising, because others are buying, or because they hope the price will increase quickly. Graham warns that this mindset leads to emotional decisions and often heavy losses. Real investing requires analysis, patience, and a focus on value rather than price movements. One of the most important ideas in the book is the difference between the defensive investor and the enterprising investor. The defensive investor is someone who wants a simple and relatively safe investment strategy. This type of investor does not want to spend a lot of time studying companies or analyzing financial statements. Graham recommends that such investors keep a diversified portfolio of high-quality stocks and bonds. A balanced allocation, such as roughly 50% stocks and 50% bonds, can help protect the investor during different economic conditions. The defensive investor should avoid frequent trading, market timing, and chasing popular stocks. The enterprising investor, on the other hand, is willing to devote more time and effort to researching investments. This investor looks for undervalued opportunities that the market has overlooked. By analyzing financial statements, earnings history, assets, and debt levels, the enterprising investor can sometimes find companies trading at prices below their intrinsic value. However, Graham emphasizes that active investing requires discipline, knowledge, and patience. Not everyone should attempt it because emotional reactions and poor analysis can lead to mistakes. Another powerful concept introduced in the book is the idea of Mr. Market. Graham imagines a stock market as a business partner named Mr. Market, who comes to you every day offering to buy your shares or sell you shares at a certain price. Sometimes Mr. Market is extremely optimistic and offers very high prices. At other times, he becomes depressed and offers very low prices. The key lesson is that the intelligent investor should not be influenced by Mr. Market's emotions. Instead of following the crowd, the investor should take advantage of market fluctuations. When prices become irrationally low, it may be an opportunity to buy. When they become excessively high, it may be wise to sell or avoid buying. Closely related to this concept is the principle of the margin of safety, which Graham describes as a cornerstone of sound investing. The margin of safety means purchasing investments at a price significantly below their intrinsic value. Because future events are uncertain and analysis can never be perfect, buying with a margin of safety reduces risk. For example, if a company's estimated intrinsic value is much higher than its market price, the investor has a cushion against mistakes or unexpected problems. This concept protects investors from permanent losses and is one of the reasons value investors seek undervalued stocks rather than popular growth stocks. Graham also discusses the importance of market fluctuations. Many investors panic when stock prices fall and become overly excited when prices rise. Graham argues that these fluctuations should not be feared but used to the investor's advantage. If the underlying business remains strong, a decline in price may simply create a better buying opportunity. The intelligent investor focuses on the long-term value of the company rather than short-term market movements. Another key idea in the book is the role of psychology in investing. Graham repeatedly emphasizes that the biggest enemy of the investor is often the investor himself. Emotional reactions such as fear, greed, impatience, and overconfidence can lead to poor decisions. During market booms, investors may chase overpriced stocks and believe prices will rise forever. During market crashes, they may panic and sell quality investments at extremely low prices. Successful investing requires the ability to remain calm and rational, while others are driven by emotion. The book also outlines specific characteristics of good investments. Graham suggests that investors should look for companies with a strong financial position, stable earnings history, moderate levels of debt, and reasonable valuations relative to their earnings and assets. Companies that have consistently paid dividends and maintained steady profits are often more reliable investments. By focusing on financially sound businesses and avoiding overpriced stocks, investors can reduce risk while achieving steady long-term returns. Diversification is another principle emphasized throughout the book. Graham explains that no investor can predict the future with certainty, and even careful analysis can sometimes be wrong. By spreading investments across different companies and industries, investors reduce the impact of any single mistake. Diversification helps protect capital and smooth overall returns over time. Graham also discusses the dangers of market forecasting and speculation. Many investors attempt to predict economic cycles, interest rates, or short-term market movements. Graham argues that such predictions are unreliable and often lead to poor decisions. Instead of trying to predict the market, investors should focus on buying solid investments at reasonable prices and holding them patiently. One of the most practical strategies Graham recommends is dollar-cost averaging. This strategy involves investing a fixed amount of money at regular intervals regardless of market conditions. By investing consistently over time, investors buy more shares when prices are low and fewer shares when prices are high. This approach reduces the risk of investing a large amount at the wrong time and helps build wealth steadily over the long term. Throughout the book, Graham stresses the importance of long-term thinking. Wealth in the stock market is rarely created quickly. Instead, it grows through patience, discipline, and the power of compounding. Investors who remain committed to sound principles and avoid major losses can achieve substantial growth over decades. Short-term market movements are unpredictable, but the long-term growth of businesses and economies provides opportunities for investors who stay patient. The influence of this philosophy can be seen in the success of investors such as Warren Buffett and Charlie Munger, who built enormous fortunes using principles derived from Graham's teachings. Buffett in particular has often explained that the lessons from the intelligent investor shaped his entire investment approach. In conclusion, the intelligent investor teaches that investing success depends far more on discipline, patience, and rational thinking than on complex strategies or market predictions. By distinguishing between investing and speculation, maintaining emotional control, insisting on a margin of safety, and focusing on long-term value rather than short-term price movements, investors can protect their capital and steadily grow their wealth. The book remains a timeless guide because human psychology and market behavior have not changed, and the principles Graham described continue to apply to modern financial markets.